Hi, good afternoon, everybody. Today is Cinco de Mayo 2022. So today's a big party day. I have several friends here. We're going to give you a few minutes to join in. We're recording this webinar. This is also going to be available on YouTube once we're finished and everything else. So, but the reason why we do the live webinars, and we just got Mr. Camilo Saab here as well. And welcome, Camilo.
Oh, good.
So,
how are you? Hello, everyone.
There we go. So I was just getting started to make the introductions. This is one of the coolest webinars that I have done because it's more of a roundtable. It's not going to be a lot of the information that we usually present. It's going to be like a cool thing for us to talk about and just inform and answer questions and things like that. So today, I'm going to start from my left to my right, without any seniority or beauty, introducing my guest today here. So I'm going to start with Mr. Bill. His name is William Frederick Scholz. Bill has been a personal mentor of mine for a long time. He sits on my advisory board. Bill has been on Wall Street for a long time. He actually has an MBA from Harvard, one of the smartest guy I know. He worked for Gabelli Investments in New York City. He managed over $38 billion in capital. So he really knows the Wall Street in and out. Thank God, God is good, took him off of Wall Street for us so we can put some more money on Main Street. And that's why I love Bill, because he has both perceptions, right? One perception from the Wall Street side, one perception from, the market itself, on the boots on the ground. On my right, I have my good friend, Graham Parham from Highlands Residential in Texas. Graham and I, we come along for a long time. You're going to find out about Graham. Graham is one of the largest investors, suppliers of mortgages in the country, actually. Him and Aaron Stelly, which I'm not going to forget about him. Also, he's one of Graham's partners, and they provide excellent service. Last but not least, my personal friend, Camilo Saab, which is the owner of Saab Capital. And Camilo today is also going to be talking about, so I wanted to define a little bit the areas of expertise of each one, what we're going to be talking about today. So finishing with Camilo. Camilo is also a mortgage lender. He's licensed in the state of Florida. Bill, I don't think you're purple for some reason, so.
I don't know what happened.
Yeah. Anyways, you look good. So Camilo, per se, he does a lot of the construction loans for all of our projects, all of our builders projects, as well as he's actually a fund manager. He manages over $1 billion as well. So we have the mortgage component, the construction loan component, the commercial, the multifamily loans. So what I would like to really pick up the brain and the expertise of you guys today is, I would like to, Bill, as soon as he shows up, talk about the most important thing that we have here today is just, what's the update on the economy? Where are we at? Do we have inflation? Don't we have inflation? Make some comparisons. See what's going on. Here we go. He's back. And then we're going to be actually talking about residential mortgage and the 1-year fixed lock interest rate from Graham and Aaron. And then I would like Camilo to talk about the market on the construction, meaning, the construction loans. What do we face as builders and developers? What is the commercial loans look like? What's the multifamily loans look like? And hopefully this is going to bring a lot of our listeners and people watching us a little bit of a pulse on the market. Just to give you an update, we now have, let me see here, how many people do we have here? Oh, we have a lot. I'm not going to talk about that right now, but I'll share with you guys as soon as we're done. So let me start with Bill, because Bill actually has a presence in the marketplace and he knows exactly what's happening in the economy, even though I truly believe economists are like the rain people, the weather people on the news. They never know what's going on. There's a 30% chance of rain and then you pour. So, I'm just going to let Bill do his thing. So Bill, thank you so much. And tell us a little bit about the economy. Today's May 2022. What's going on?
Yeah. Well, as you pointed out, economists, if they had to keep their job by being accurate, they'd all be driving for Uber, just like weathermen. Let me give you a couple of quick data points to help point out where we are. Since I had a background on Wall Street, and by the way, my boss actually, Mario Gabelli, actually ran the 38 billion. I helped him raise it. The Dow and the S&P 500 had the worst April in 50 years, since 1970. Unbelievable. The inflation rate hit 8.5% in March. That's the highest rate of annualized inflation since 1981. Foreclosures, this is pretty interesting, up 181% in 1 year. And home sales were down 12.6% versus last year.
Can I just stop you for 1 second, Bill?
Please,
What was
please.
the foreclosure between 2021 and 2022?
Yeah, up 181%.
I would say
Up
that's great
181.
news. I would say that's great news. And people are going to look at me like I have 3 eyes. And what I'm going to tell you this, we're becoming a renters nation. The regular
Absolutely.
people cannot afford a house anymore. And that's sad. And I feel for the people that are now losing their homes. But the reality is, for you, investor, mom and pop investors such as me, Graham, I know he owns a ton of property here as well, Camilo, Bill, this is good news for us, guys. Unfortunately, people are not affording their homes. So I feel for you if you lost your home or if you are in foreclosure, but pay attention to those numbers. Not every bad news is bad for everybody. When somebody cries, somebody usually sells tissues, right? So take a look at the opportunity, because this is real. Go ahead, Bill. I'm sorry, I didn't want to interrupt. I just got to control myself.
No, it's quite all right. How many housing units are you bringing into the market that people can rent?
In the next 5 years, we're calculating to have over 3,270 units. And just to give you a little bit of a flavor, the Fannie Mae and Freddie Mac has announced that they are in need of over 5 million residences in the US in the next few years. So, imagine we're not even touching the surface. So there's a huge demand of housing coming up, because you gotta remember, why do we need so many housing? Between 2010 and 2014, nobody built anything. There was no new construction happening, right? So we have all this 3 or 4 years to catch up and build more houses, because people are still coming from overseas, net in migration to the Sun Belt states. So I don't want to steal your show, Bill. Keep going, and we'll keep,
Quite all
chiming
right.
in. So I
I'm
appreciate
going to
it.
be brief, because you've got 3 very intelligent people with a lot of experience, and we want to hear from them too. I'll just give you a couple more data points. The GDP, gross domestic product, has been down 5 months in a row: November, December, January, February, March. The official definition of recession is 6 consecutive down months. If April is down, we're officially in a recession. The Federal Reserve yesterday raised the Fed funds rate. That's the rate at which banks borrow money from the Fed window, by 0.5% yesterday. The Fed funds rate is now between 0.75 and 1%, between 0.75% and 1%. The Fed announced it intends to do 5 more hikes before the end of the year, and rates will be 3 to 3.25% by the end of December. They also plan 2 more rate hikes for 2023. So rates, short-term rates, will be 4 to 4.25% by the end of 2023. Real quickly, the other 2 data points I'm going to give you: the trade deficit for the first time in history went over $100 billion in one month. Wow. We had $110 billion trade deficit, and that trade deficit took 3.2 percentage points off of GDP in the first quarter of this year. So it resulted in a GDP contracting at 1.4% after growing 6.9% in the fourth quarter of last year.
So, Bill,
economists were predicting 1.8% up in the first quarter. Instead, it was minus 1.4% because of the record trade deficit. Sorry, Wagner, go ahead.
No. I just wanted to, as you know, I'm not a very smart guy. I like everything in layman's terms. So can you translate for us what's happening? What that means? What does that mean?
Yeah, we're buying a lot more stuff outside the United States than we're selling them. We bought $110 billion of more goods than we sold to our trading partners. And one of our biggest trading partners, again, is China. So all that stuff that happened 5 years ago when we were bringing manufacturing jobs back into the United States, and that's the other data point I'm going to give you, and then I'm going to shut up and let the other gentlemen have their say. The ISM jobs index for April was down almost 50%, which means manufacturing employment is down hugely. So those jobs that were brought in 5 years ago for manufacturing, they're disappearing because we're buying things in China and in Mexico and other places, some of our largest trading partners.
Yeah, no,
Go ahead, sorry.
that's kind of scary, actually. But that actually tells me one thing, if I may, is supply chain interruption and issues we're having right now for construction and for the real estate market is going to continue to increase. We don't have a solution anywhere soon. And if you take a look at one of the most appreciated cities in the US at one point, Detroit, look what happens when we send manufacturing outside and we lose jobs, right? So luckily for us, I think we are in the state of Florida. And before I'll let you guys go, I want to share my screen and I want to tell you the only thing, in my opinion, that can slow down the state of Florida. And I'm going to ask each one of you guys before I show this. What is it? Graham, you do a lot of loans here in Florida. What can actually slow down the state of Florida?
Supply.
Supply.
I mean,
okay.
What's interesting, and Camilo, join anytime you want, but with these rate hikes, most of the people that were the first-time home buyers, as you alluded to earlier, and some of the people, even second, third-time home buyers for the primary residence, are starting to fade out a little bit, or slow down, if you will, because they're scared about the rates. Not only from just the fact that they just don't like to look at those rates, some can't even afford the house because you raise the rate, and the next thing you know, your debt to income ratio may be busted. But what we're seeing in March, we doubled our applications in March. So we only can say that the guys that are sitting on the sidelines, now they want to jump back in. Let's go ahead and capture some of these properties before the rates go through the roof. So that's the only thing I can conclude. Camilo, I'd love to hear your comment on that.
Yeah, the mortgage, I live in both worlds, right? We do have a small presence in the mortgage and mortgages. We've seen applications actually decrease about 20% as rates came up. So we've seen slight decrease in applications on the mortgage side. On the construction side, which is 90% of what I do, that's the exact opposite. The market's on fire. We are on track to close about a billion this year in construction lending, and we are just constantly having new projects being presented to us. So project-wise, the number has increased for us in terms of the construction side. We have our issues. Construction is taking a bit longer because of the supply chain disruption, if you want to call it, and there's really nothing that we see in the near future that could potentially resolve that. And so construction, mostly workforce housing type of construction, we see a lot of volume coming in for those types of for that type of construction.
That's good news.
So your customers are betting on the calm down the road. And I guess, for the lack of better words, so are mine, because we're right behind you. You start building it, we're ready to take you out at the end. So yeah, that's interesting. Bill, actually, I've got a question for you, since Wagner so elegantly put that there's smarter people on this webinar than him.
Not me.
Well, I'm not going to test
me.
Smart guys. But what I'd love to ask you, because I try to stay as current as I can on the market, and I know we had the Fed increase yesterday. But they're also planning to sell off about $47 or so billion off of their balance sheet. I think about 30 of it's in treasuries, the rest are in MBSs. How does that affect the market, in your opinion?
Who's selling money? You talk about the Fed.
The Fed are selling off their balance sheets.
Yeah, the Fed is getting out of the business of managing treasury bonds and treasury bills and treasury notes. They have no reason to have built it as large as they did. Same thing with Fannie Mae and Freddie Mac. They wound up with a gigantic portfolio, which they wound down during the crash. It's one of the reasons they got in such trouble during 2008. But aside from that, they have no business managing a $9 trillion portfolio of treasuries. They're getting rid of it. It's It's not the business that they're in. Their business, the business of the Federal Reserve, is to provide a stable interest rate environment. When the party gets too heated, as one of the famous economists said, the Fed's job is to take the punch bowl away, so people don't get drunk at the party.
So I think we all can agree that we are headed for a recession, but we all just don't know when. Do you have a prediction on that?
Next month.
Wow. Okay.
I mean, if April is down, it's official. And by all measurements, April's going to be down.
So
that's
that's all
6
kinds of
months in a row.
predictions. A year from now, 18 months, I predicted fourth quarter, but if you're predicting next month, wow, that could
Yeah,
actually be in our
that's
favor.
fast. And a typical recession usually lasts only 11 months, but some of them have lasted a lot longer than that. You remember the Great Depression, that was
Right.
13 years. So recessions usually 11 months, but sometimes longer. Go
Okay,
ahead, Camilo. We didn't
let me
interrupt
just
you.
show you an
But-
image that
Go
it's
ahead, sorry.
1,000 words, and then we're going to come back to the conversation, because in my
Okay.
opinion, there's only one thing that can actually slow down the state of Florida, and I'm going to show it to you. Let me share my screen.
Hurricane? I've seen that video.
Only one name comes to mind. Welcome to TMZ Live, accurate news and enthralling stories.
Hold on, that's not it.
Oh, just that one shot, just that one picture. Yeah. 11-foot gator shut down 417. There it is.
Wow.
Jesus,
It's a monster.
Oh,
that is a
man.
monster. That's a dinosaur.
So this is
That's
the
right.
only thing, in my opinion, that can actually slow down the state of Florida. It's a massive gator on the interstate. So unless
mean-
that's not a concern for you, like it's not a concern for me, I don't think we're going anywhere bad. So we can actually, in the best interest of time, continue our conversation. What I would like to do is I would like to actually build this round table from the bottom to the top. So I'm going to pass the ball to Camilo right now so he can tell us about the construction loans, because everything starts with the land, acquisition of the land, development of the infrastructure, horizontal, vertical, and then delivering of the homes. And then once we come to mortgages, to the final investors, I'll pass it along to Aaron and Graham. Is that okay?
Yeah.
All right. Camilo, tell us, what's the magic? And let me just say something publicly here. Last week on Thursday, actually, I closed some construction loans with Camilo for some properties that we're developing. So
Yeah,
thank you, Camilo.
congratulations.
Yeah, I wanted to make a public thank you, because we signed a good sizable construction loan with him for some properties that we're developing ourselves. So thank you, Camilo. Appreciate your help.
Yeah, congratulations. First of many, hopefully.
Exactly.
I mean, I can talk to you guys a little bit about what I see in the market right now. A lot of my clients, they buy the land as dirt. They spend the money entitling the land, meaning getting it approved, zoned, permits, all that good stuff. They do the horizontal, which is the site work, everything underground, piping, water, sewage, electricity. Once all of that is done, so the entitlements of the land should take about 6 months, another 6 months for site work, let's say 12 months for you to have a project ready to go vertical. Depending on the size of the project, if it's a multifamily, single family, construction can range from 5 months to 18 months, depending on the size of the project and complexity. Right now, our money, the cost of funds that we're actually seeing at the end of the day for our clients is ranging around 4.5% to 5%, which for construction is ridiculous. I mean, it's really low, right? So on a traditional construction loan, we approve the project, let's call it a $30 million project. The client only draws money based on inspection. So as the project progresses, we release funds accordingly. And so project can take as long as, it can move as quick or take as long as construction takes. We are seeing projects take a little longer because of the material issue. A lot of our clients, what they are doing now is they're in the beginning, let's call it a multifamily project, what they're doing is they're closing out their budgets. They're literally buying windows, trusses, a lot of the big ticket items day one. When they close the loan, they already purchase the big materials, because those certain materials are taking 23 weeks to be ready to be installed in the property. So you know, and it's not stopping. I mean, there's a housing shortage. I mean, I don't know if it seems like it's all over the United States. If we are in a recession, it doesn't really feel like it. There does I mean, I do feel it, that I do feel in our everyday transacting that there is no inventory in the market right now. There's no inventory. Stuff that is sitting around kind of flies off the shelf. We're still in a very bullish market here in Florida. And so even if we are going to be in a recession here for the next 12 months, I mean, we need housing. So I think the group here, we're going to be busy. When it comes to rates and mortgage rates, yeah, rates have come up historically. I mean, for the right investment, rates are rates. I think, you pay the price at the time. I mean, on a 30-year fix, you're still okay. So I'm going to pass it on to Graham right now. Probably has a better pulse of where mortgages are and applications. If you guys have any questions, feel free to fire away.
I just wanted to, because as I keep telling you guys, I'm not smart. I got to be simple. So if I understood correctly, what you're trying to say is this: as long as the builders and developers are continuing to borrow for development, this market won't stop just because we don't have enough inventory. So it doesn't matter what happened to the interest rates, doesn't matter what happened to the economy. People need housing, people need healthcare, people need food, right? You may not buy a brand new car, you may not buy a brand new banana and pajama shirts or whatever. I was called the banana in pajamas today for the shirt, but in reality is people have to eat, people have to live, they need shelter, and they need healthcare, right? So at the end of the day, if I understood correctly, the amount of demand for construction loans are up, and you don't foresee anything changing, correct?
No, projects are actually getting bigger and bigger. So we have in our pipeline, we're closing next week 1,200 units, one project. Reunion local here, they're building another 1,800 units. I mean, we're talking about, our friends at D32, they're going to be at 3,500 units this year. So, I mean, we
just sold the project for another developer. The Camilo is doing the financing, 256 townhomes in Winter Haven, Florida. So, I mean,
that one
from our side, we don't see it, but I just wanted to confirm with the experts that that's what I understood. One more important point as well, because I really believe in having boots on the ground, and we own a property management company in-house. Our property management, every house, brand new house, we only do new inventory that we put on the market to lease. We usually have 40 to 50 tenant applications. What does that tell you? There's no houses available for rent in the market, that is especially new, right? So, and those tenants, they tend to stay between 3 and 4 years in the same house. Why? Because you have the newest and the best looking house on the street. So at the end of the day, guys, if you invest, if you find the right product, doesn't matter if it's in Florida, if it's from us, but take action, make it happen, because at the end of the day, this market is not changing. So passing along now we built the house, Camilo funded the pre-construction, Bill already forecasted what's happening with the Fed, Fannie Mae, Freddie Mac, the Fed. Now it's time for you to obtain the beautiful mortgage. What's going on, guys? Aaron and Graham, what's going on now once you're ready for those mortgages?
Well, I got to tell you, I thought we'd slow down this year, but Aaron, you're welcome to jump in. Like I say, I've been on vacation since Wednesday, so I didn't get in until late last night, but he was crazy busy this week, and we were crazy busy last month. We're blowing the numbers out of the water, and it's because the demand is still there. As Camilo says, people want to invest regardless of wherever the rates are. And I refer to our good friend Richard Smith. I'm going to bring him up. He's my accountant. He's an investor. He's been doing buying properties for over 30 years. And I use him a lot saying, any rate below 7% on an investment property is still a good rate. And that's true today. It really is. And these other people that, brought up themselves trying to invest during the pandemic, well, where's my 3.5%? Well, that ship sailed, it's gone. Well, if I can't do that, I'm not going to invest. Well, then you probably don't need to be an investor, okay? Because there's enough inventory out there for other investors. Because if you pass that up, there's 20 people standing behind you. Do I need to say any more, Wagner?
Today, I mean, we can keep property in inventory. Thank God that, starting in July, we're going to have about 80 units coming live every month for sale. But as of right now, everything we have for sale, it's selling quite quickly. Customers are, in high demand, and that's why we have an online reservation system, because if I send you an email with a unit, by the time you say yes, the other person already grabbed it. So it's first come, first served. There's no inventory, especially because we sell directly from the builders, no middlemen. So our prices are lower than actually the fair market value on what you buy it on retail. So at the end of the day, we can keep properties in stock. And what I would like to actually ask you guys as well, Aaron and Graham, is you guys created a program that it's very, very interesting. And for me, it's like an insurance policy. So can you tell a little bit about the fixed interest rate for 12 months that you guys have?
I'm gonna let you take this one, Aaron.
Yeah, absolutely. And definitely appreciate you bringing that up, Wagner. So, luckily about, I don't know, say 2 months time ago, our company finally kind of let us unveil something that we've had in the works for a little while, but just haven't quite been able to get it out. And exactly as you mentioned, on these new construction purchase homes, we are actually now have a program out that allows us to lock in that interest rate today for up to 12 months. So given the environment that we've seen, just to start this year alone, we've had borrowers left and right who are, looking to acquire these new builds, taking advantage of that time and time again. And exactly like you mentioned, Wagner, the easiest way to kind of think about it is that of an insurance policy for their rate. So to put it really simply, it all kind of depends. The borrower can lock it from a 4-month time all the way up to a year. And depending how long they decide they want to lock in, there's a small adjustment that we do to the rate. So for example, right now on our 30-year fixed rate, we're right around 6% as far as kind of your standard investment property rate. Keep in mind, that's going to be a little bit higher than owner occupied. So we're going to be right at 6%. For example, if we were locking in the year-long program with the borrower today at 6%, the adjustment to that is we add 1% to it. So they'd be at 7%. That would be protected for up to a year. 10 months go by, rates are up at 9%. They're still at that 7%. And then how the whole insurance policy comes into play is once we're within 30 days of closing, we still have a float down option available. So say they're at 7%. Fast forward, we're at May 2023. Rates are sitting nicely still at 6%. Well, we're going to go and lower their rate down to match that current market environment. So to use the program, the borrower, when we do lock in, they do have to send in a 1% deposit to use the program, but they can think of that exactly like earnest money. They get that back on at closing, just like earnest money. That'll be credited back to their total cash to close. So just given what we've seen over the past couple months, really the past 2 to 3 months, with rates just continuing to kind of spike, this program has been a great benefit, really gives our borrowers that peace of mind so they can move on to the next thing, move on to the next deal, and put this new construction in the bag.
Aaron, I don't think you could have said any better. The way I see this is this. Why do you pay car insurance, home insurance? So you don't have to use it, right?
Exactly.
Nobody wants to get into an accident to use your insurance. So this 1% from the total purchase price is your peace of mind, is your guarantee that you're going to go home, you're going to put your bed on the pillow, and you're going to have the same interest rate as you locked in today. Plus, with the benefit that, if it comes down, you guys will actually credit that as well. So, I mean, it's a no-brainer. Now, For people that never bought real estate, which I don't think we have anybody watching this webinar that is that kind of a person, but if you are, it's fine, right? I mean, everybody started from the beginning. For you to lock an interest rate, you need a contract, you need a property. You gotta identify the property so you can lock in your interest rate. So the first step is identify an area, could be us, Florida, I love Florida, but anywhere you want, identify a property, get into contract, right? Once you have the contract and you follow the steps, you can actually go ahead now, lock it in your interest rate and start the whole process. I'm gonna actually ask for final remarks from each one of you guys, but I'm gonna give credit to where credit needs to be given. And Camilo just shared a slide with me that I would like to share with you guys that my jaw just dropped. So let me do this. Here we go. So
Wow.
This is actually the number of houses that were built in the US decade by decade. So if you can see from 1930 to 39, here we go. The highest years, right, as we knew, is 1990 to 99, 2000 to 2009. And just that I had described to you guys from 2010, actually, I thought it was 2014 to 2019, we built less than 1/6 of all the houses we needed in the US. So if you take a
What
look
happened?
at the inventory in millions, we have such a deficit of housing in the market. And that explains why is the market so hot. Also, if you pay attention to the market, is I always tell people, do not invest where the sun doesn't shine. The sun belt is where you, and I'm sorry, my camera keeps doing this Zoom thing. Apparently people don't get it. It's easy. Go to www.uhaul.com and take a look where the trucks are going, right? Where are people moving from and to? As I told you, I'm a simple guy here. It doesn't, you don't have to, this is not, you don't have to work for Fannie Mac and Freddie Mae and have a big executive degree in anything. Guys, follow the U-Haul trucks. That's where the people are moving to, and that's where the jobs are going to. If you take a look at the state of Florida, everybody's coming here. Why? No state income tax, business friendly, no rent control. I mean, you start getting all of that, fastest MSA growing in the 2021, it's the villages in the whole country. So you start looking at that low cost of living compared to other places. And you're like, okay.
Pretty good weather too. Pretty good
Well,
weather.
yeah, we're not going to even say that because, there's people freezing watching this right now. But at
Well,
the end
I'm
of the
gonna
day,
try to move down there myself. So I'll be down there in 3 weeks and you can show me around, Wagner, but
and
I'm in full agreement with you. I'm out of Dallas, so we
Yeah,
have to weather, but
and by the way, I'm going to go to Dallas tomorrow for an inner circle meeting with my great friend Kyle Wilson. So, I might not have the time to see you guys, but love Dallas, love Texas, great places. So we have being represented here, Texas and Florida, great states. Guys, I want you guys to have your final remarks. I'm going to go back once again, and I'm going to do this differently because Graham and Aaron, you were last, you're going to be first now, and then we're going to just, return here. That's what Jesus said, right? If you're the last, you're probably going to be the first one day, and here we go.
well, as Bill said, we are expected to see the rates to continue to go up. Maybe the recession will kind of help relieve some of that pressure, but we just don't know yet. The rate lock program that Aaron just designed or just described, it's perfect. It's an insurance policy. It has a ceiling. It does not have a floor. And if you keep that in mind, that's all you need to remember.
You couldn't have said any better, Graham. I mean, that's a way simple way to look at it. I took advantage of all those offers, and Aaron, you're next, man.
Yeah, no, and I would just echo, more along the lines of what Graham said. And, throughout this year, a lot of our investors have found reassurance, peace of mind through that extended rate lock program, and allows them to, again, pack up that deal and move on to the next one and keep growing their portfolio. So my words of wisdom, I would guess, would, don't let this rate environment scare you or, be timid and stick to the goals, stick to the numbers. And like we mentioned, we've got this great program that can kind of help protect and aid with that along the way.
Great. Thank you, Aaron. Mr. Camilo Saab, my friend, You are, this guy does so many deals, and I'm gonna tell you, he keeps his pen on his ear so he can actually keep signing deals. I mean, deals after deal. Look at this guy. He's just amazing. I love you, man.
Crack me up, man. No, I appreciate guys. This was very, very insightful. It's always great to hear from other professionals and, hearing you guys' experience on the other side of this country, the other side of the country, potentially. Congratulations on the success there. Let's keep up the good work. I think there's lots of work to be had. There's a lot of inventory coming to market. Let's keep up the good work.
Camilo, I have to say that for all the three of you guys that are in the finance industry, I mean, you guys are the backbone of what we do, right? I mean, without you guys, there's no houses, there's no, mortgages, there's no investment, because it's so important to what we do to have people like you. So I wanted to personally thank all the three of you for what you do, for all of us. So I really appreciate, and I wanted to say that the amount of gold and the amount of assets that we have in this roundtable, this webinar today, I couldn't afford to pay. So, I mean, I really appreciate all this knowledge, all this content that is being shared by each one of you guys. And hopefully we will be able to help a lot of people out there as well to get the knowledge and to probably just, take that first action and make something happen for themselves. Bill, last but not least, my friend, I want you to do your remarks, but I do have a question for you. If you had that $38 billion today sitting around, where would you invest?
Seriously? Wow, that's a great question. First of all, you want to diversify. Secondly, you'd want to be in industries that are recession resistant. There's no such thing as recession proof, although I thought it was really interesting when somebody once pointed out that the companies that do best during recessions are pawn shops. Keep that in mind. It's hard to find stock in pawn shops, though. But food companies, we all got to eat. And there's currently, according to the president of Goya Foods, one of my favorite brands, a looming food shortage, because the two countries that produce together 50% of the world's fertilizer are Russia and the Ukraine. That's not a comfortable situation to have half of our fertilizer in two countries that are at war and with a looming, supply chain crisis as well. So Mr. Unanue, who was president of Goya Foods, says last month that we are facing a looming food shortage crisis in the United States. So leaving those negative things aside, I would invest in industries that are recession resistant. Utilities, we're always going to use electric power. Industries such as auto parts, industry that we've invested in when I was working for Mario for years. What's one of the first things you do when the economy is bad and you're not making as much money? And you look at the price of new cars and you say, that's a little steep. I don't think I want to pay $50,000 for a Tesla. I think I'm going to keep my Ford another 5 years. So where do you go? You wind up going to the auto parts companies, Napa, and you put some new parts in the car, new muffler, new transmission, whatever, and you keep it another 5 years. The auto parts companies do extremely well in recessions. The average age of a car in the United States today on the road is 7.5 years old, believe it or not. Yeah, okay. Yeah, we don't see those cars. We see in big cities all the fancy, shiny new cars. We're not looking at the hinterlands, the flyover territory, where they're still driving pickup trucks for 15, 20
So Bill,
years.
I'm going to interrupt you just for 1 second, because I'll be honest, I don't own any stocks, and I don't care for stocks. So,
real estate.
No, well, no. What if you had? Okay, you heard Bill. If you are a stock guy, listen to Bill. He's a Wall Street guy. Forget Wall Street now, what would you buy that it would be leverageable against inflation? I mean, give me. I know you're gonna say real estate, but give me more options, because I want people to have diversity. if you would actually have capital to invest in stocks, which you already said, you know, auto parts and food and
Or bonds, or bonds.
okay, or
There's
bonds.
something called a tip. There's something called a TIPS, the Treasury Inflation Protected Security, which pays the inflation rate. A lot of people don't know about this Treasury bond. It's denominated in 2-year, 10-year, and 30-year denominations, and it pays you at the end of the year the whatever the inflation rate is. So your current principal, so if the inflation rate is 15%, that's a Treasury bond that's going to pay you 15%. That's
huge.
unheard of. Yeah.
So that's the tip of Bill for tips.
TIPS, TIPS, Treasury and Inflation Protected Securities. But seriously though, real estate is probably one of the safest places to be, simply because the stock market encourages you to sell stocks. They price the stocks every quarter of a second. You see the numbers flashing, so people get nervous and they sell their portfolio. Before Zillow showed up and started pricing houses on a daily basis or hourly basis, you didn't know what your house was worth. That's one of the reasons why people kept their houses as long as they did. Turnover in real estate is much slower. And frankly, in investing, this has been true for a long time. Buffett said it best. He said, I didn't make most of my money buying stocks, and I didn't make most of it selling. I made most of my money waiting.
And let me tell you something, Bill, you're a smart guy, but I had, if you guys don't know, I did actually a podcast with Bill that it's real estate against the stock market. And one of the things that I always tell people is this: if you have $100 a year ago, right, you could buy $100 worth of goods. But because we are now in 8.5% inflation, if you have $100 today, it's only worth $91.50. Plus, that's how much your dollar has devalued compared to 1 year ago. Plus, your purchasing power has decreased tremendously. The house that I was selling for 180, 163, 169, then went to 189, 198. Today, that same house is retailing for 284. So, you know, your dollars cannot buy the same amount of property. But forget about all of the, you know, inflation and the loss of the value of the dollar. Let's talk about leverage, right? With $200,000, you can buy $1 million worth of real estate. In stocks, you can't. I mean, you can probably leverage up to 50%, but if you have a margin call, you either lose your stocks because they liquidate them or whatever. So there's nothing in the US that you can utilize leverage with fixed interest rate to buy assets, real assets. So it's crazy when I tell people, why don't you buy real estate? And they're like, they don't even know what they're missing on. I'm not going to even get into cost segregation, bonus appreciation, because that's a whole different thing. And when you get into the tax, I mean, I love paying as much tax as I have to, but I'd only pay what I have to. And real estate is one of the biggest conduits for you to save taxes and make more money on the long run. And I agree with you, Bill. You know, Zillow actually makes people think that their house was worth 100,000, now it's 400,000, but it doesn't matter. You only make money or you lose money in real estate when you sell it, right? So it doesn't matter if you keep it with a smart investor mind. You can do 1031 exchanges and not pay any capital gains on that. I mean, there's so much you can do. But in reality, Bill, I did not know about tips. That's awesome. And I appreciate you liking real estate. I mean, I know you have a little bit of Wall Street in you. We're not gonna blame you for that, but we appreciate you appreciating the real estate as well. And one of the quotes that Warren Buffett did as soon as Fannie Mae and Freddie Mac created the 10 maximum loans per person, per US citizen or resident, Warren Buffett came in and he says, I wish I would buy 200,000 houses. And they said, well, you can only buy 10, just like every American. So if Buffett is actually looking into buying property and looking at those subsidized rates, you should as well, because that guy only invests where value is to be had. That's right. Thank you, everybody. Do you guys have any final remarks before we go to questions? Because no, we did good. We have 15 minutes for questions. So
Good. Thank you. This was really interesting for me too. I learned a lot.
Yeah. So do you guys have any final remarks? And we're going to open up to questions. So if anybody has a question, please let us know. Start sending us the questions. All right. So I have one question here for Mr. Aaron and Graham. Can you explain in details what this 1 year lock looks like and what will be the interest rate today if I decided to lock in the interest rates?
Go ahead, Aaron. You just said it earlier.
Yeah, so today, for example, just to give you a comparison, we'd be right at 6%. That's the true rate today. So if we were locking in on our standard 50-day lock, we'd be right at 6%. For example, if you were opting to use the year-long program, we add 1% on top of that. So you'd be at 7% would be the official locked interest rate for the year-long program. And again, once we're within 30 days of closing, if those rates do go down, there is that float down option available to take advantage of that. So it does differ based off of how long you are looking to extend the rate. If you're looking at either 270 days or 360, we're going to add 1% on the current rate. If you're looking at 6 months, 180 days, we're going to add 0.5%. And if you're looking at 4 months, we're going to add 0.375 on top. So that's kind of how the program works. And we would, of course, encourage, we can go over that one-on-one in way more depth. So we would encourage, anyone to reach out to our Parham team email address or both of our direct phones. And we'd be happy to provide more info on that and dive in even greater depth.
Thank you. I appreciate it. I have another question for you guys that actually, I don't know how this came to my desk here, but somebody printed a question. I'm going to read it to you guys. It's crazy because let me understand. Let's say I lock in my rates for 3 months and my house is not ready. Can I upgrade to the next level of time? How does that work, Aaron?
Let me take that one. That would be a case by case. Okay. I think we've even had that situation with you, Wagner, that we did make that exception. In other words, they're trying to limit their add-on. Okay, like Aaron mentioned, okay, 4 months is this, 6 months, so forth. The longer, the bigger the add-on. Okay, and so a lot of people want to take the conservative route, but Camilo said it himself. I mean, back order on trusses, windows, appliances. So we just don't know what these delays are, permitting, you name it. And these things are uncontrollable even as a builder. And so, and I have to say this universally, if a builder says we're going to be done in September, you might as well count on October, November. I mean, that's just a safe bet. Yeah. And so people say, well, I'll just go with the September. And then you come back to them and say, really, it's going to be November, October, whatever. They come back and say, can I extend anything for it? It's case by case. I do have to get an exception, but yes, we can do that.
Okay, thank you so much. That's great. Let me read this one for you guys. It's quite of a long one. This is actually a client that has been working with us and you guys. So he said he asked his lender about the rates, and at that time it was a 5%. He's trying to understand where we are right now. So you guys are going to answer that. And he's buying 3 properties from us. He's putting 20% down, and the purchase price of the property is $225,000. He has excellent credit. What does that look like for him if he locks his interest rate today? What will be that rate today if he decided to lock that interest rate today?
Aaron, you've been looking at that more this week, so I'm gonna let you run with this one.
Yeah, to kind of dive into the current rate environment even a little deeper. So it is going to differ based off of if the borrower is going to put 20 or 25% down. It's good to know there will always be, almost always a pretty significant break at that 25% down allows rates to be a little more favorable. To kind of backtrack, I heard him mention say 5% in there. Over the past, I'd say, coming up on 2 months now to 2.5 months, we have seen our rates go. The market has gone up, about 1.5 to 2% in whole. So this time at January, even beginning of February, we were sitting right around that 4.5. Now, as I said, we're right around that 6%. So, for example, just to go deeper, 20% down, it's not going to be as favorable. You're going to be looking closer to 6% with about 2 points. Historically, we've always gone away from points, quoted our borrowers 0 points. But where the market has been at the past couple months, that 0 point pricing is no longer there for investment properties. So 20% down, you're going to be in that realm. Versus 25, it's more case by case, but we're seeing still 6% with about 0.5 point to 1 points. Just the other day, I got a little lucky, was able to get one in with 0 points, but that was kind of rare. So 25, you're getting, either way, you're looking around 6%, 1 point if you're doing 25. 20% down, you're looking closer to 2 points. So hopefully that gives our number crunchers out there a little of ammo to work off of.
That's
They
great.
just don't, because it's the last, say, month, the Wall Street, the people that are buying these loans on Wall Street, they just, they have to determine their flavor for risk from one day to the next.
Right.
When we get these prices and these coupons, from them each day, even with Fannie Direct, those margins have compressed in the last, say 30 days. And what Aaron was describing, the 0 point we refer to as a par pricing, was always available up until about a month ago. And then we're saying, the rates keep going even further, the margins keep getting more compressed, and that par pricing just doesn't there. So, that's why we have to charge a point. It's not just us, it's the whole industry is like that. Camila, I'm sure you can agree on that one.
I was just going to ask Camilo the same thing. I mean, from a different perspective, Camilo, what do you see on your market here in Florida?
In terms of construction or residential, or like
no, let's talk about residential, because construction loans, I think there's very few developers on the call, and I can tell you construction loans are actually extremely high because I just closed one last week, but you only pay for the exposure of capital that you're utilizing. So at the end of the day, we pay, so you guys understand, and Camilo can confirm this, we're paying 8-9% a year on a construction loan basis, but we only pay on the exposed capital. So we bring in 20, 30, 35% loan to cost, and then we actually go ahead and we pay. But you got to remember, we only pay on exposed capital. So we only going to pay a lump sum right at the end of construction, when exactly it's the time to deliver the property and to close on the property with the CO and everything else. But it's extremely high on our side as well. So if you think 6% is high, don't go into the building business or development business, because you're going to go nuts. It's a whole different game. It's a whole different animal. So Camilo, teach us, give us some nice info.
I mean, I still think the product that you have available is an attractive investment. And Mr. Scholz, I think you can attest to this. Fees and fixed costs are the worst for any type of investments, right? So on a 30-year fixed, if you're at 6-7% with low property tax, no HOA, and insurance fairly reasonable, I mean, your fixed costs are very low on these investments. If you put 25% down at a 6% rate on on the type of properties that Wagner sells, they're not expensive homes. These properties are still cash flowing at 7%. I mean, these are still very reasonable investments. Real estate investments that will appreciate in value. There are various other benefits as well. And so, we rate, regarding rates, I mean, we've been spoiled. We were in a low rate environment for quite some time, and everything was very stable, and we got spoiled. 6% rate is, if you're looking on a 40, for the last 40 years, it's not a high rate.
Right.
I mean, it may be mental, like a psychological impact, because it did go up very quickly, right? It was 3-4 months. It went from the 3s to the 4s to the 5s, and I was like in the 6s. But I do believe that the worst is behind us. We should see less volatility moving forward in terms of interest rates. I think the market did react very, very abruptly but I think the worst is behind us. We will see rates slightly go up and come back down in terms of, so the volatility should slow down when it comes to that. But, you know, real estate is a safe investment. A 6% 30-year loan is a good, it's a good rate. It's a good product.
Yeah, I have a
Absolutely.
couple. Yeah, got a couple more questions here. Guys, I'm just gonna say the first name of this person. Ariel is asking, is that 6% subject to a minimum score? So for each qualified to that
Yeah.
minimum 6%, what will be their credit score that they need to have?
Yes, so credit, the rate is always going to be impacted by the credit score. On our end, for example, the best pricing we can give tiers out at 740. So, you know, the borrower with 741 or 815 credit would be in our best pricing category. From there, it does go in basically 20-point increments underneath that. So 720 to 740 is going to be a little worse, so on and so forth. So that will, of course, impact the borrower's rate overall, but important to know that, at least for us and most lenders out there, once you get over 740 or generally a level right near that, you're going to be in the best pricing tier that they've got to offer.
Yeah. Thank you, Aaron. I appreciate that. Ariel, you got your answer, my man. Hopefully you have great credit. Move forward. I have an anonymous attendee that says, home construction trends is interesting to see. It is clear we didn't build enough homes, but should we see that relatively to population growth for the same time period? Won't the ratio of home construction / population growth be a better indicator of the trend? And I'll answer that one for you. Look, let's be very honest. We don't have enough inventory. Let me take a step back. We are becoming what we call a renter's nation. People cannot afford to buy a property nowadays. Millennials don't have good credit. They have student loans. They make good money, but they don't want to have the maintenance, the property, cut the grass or anything of that nature. This millennials, and now actually, as we see on the villages, it's trending to become the seniors as well. Seniors don't want to own a home anymore. They want to rent. The reason why is because they don't want to worry about maintenance, or what we call in our line of work, CapEx, capital expenditure, right? It's what's going to take for you to maintain the property. So it is extremely important for you to follow demographics. It is extremely important for you to follow trends. It is extremely important for you to see available inventory on the market, but most important, what jobs are going into each individual area, how much inventory is available, how much are they renting for. And this is what we do when we build. I schedule a meeting with the economical development team, the mayor or the city manager in every county or city we build. And I ask them, who is coming here? What jobs are coming here? What product do you guys need here? Remembering we only do entry-level properties, right? I don't do anything middle of the road or high end. And they tell me, Napa Auto Parts is bringing it in, a brand new distribution center. Chewy is coming here. FedEx has a brand new hub where they're going to unload all the cargo and distribute. Amazon is putting up a 2 million square feet warehouse. University of Florida is building a brand new hospital. When you see that come in, you're like, oh, I like technology, I like distribution, I like healthcare. That's an area that I want to be. How much inventory is available? Minimum and very old. That tells you a signal. So everything we do is based upon data supported by the county and the city. We don't actually do, oh, I think I'm going to build in Palm Bay. Yeah, it doesn't work like that, right? So follow the leaders. That's what I tell people. You don't have to be smart. Follow the smart people. Who is in Palm Bay? Richard Branson with the bright line. If you guys heard the name Elon Musk, he's there with SpaceX. If you learned the name Jeff Bezos is there with Blue Origin. I mean, and many over 400 technology companies. When you see that happening, the trend happening, something good is coming, right? Ocala, same thing. So the answer to you is this. All those ratios are really good. But unless you have boots on the ground, you don't know what's happening. And I'll tell everybody, real estate is local. Do not believe what you see. If you want to get to know an area, drive, go to the supermarket, see how much the shopping malls are actually, how busy they are. Go to a restaurant, see what's happening. Take a look at the local economy, because that's the only way you're going to be able to succeed in real estate is by going local. So I really appreciate, we don't have any more time for questions. We have more questions here, but guys, I really, really appreciate Camilo Saab, my friend. Thank you so much for being here, brother. Bill Scholz, my brother, my mentor, a person that I always go to for advice. Aaron, superstar, I wish I was your age with your knowledge. And my friend, Grant Parham, that actually just came back into town last night, and he made an exception to be here with us today for you guys. So
I learned from listening to every one of these guys today. I learned from listening.
This is why
Same here.
I was just gonna get
Same
another
here.
cup of coffee and stay here for 3 more hours if I could. I mean, this is so much fun, right? And I really appreciate, if I may leave one advice for each one of you guys, is the best opportunity to plant a tree was 10 years ago. And if you didn't, today's the day, right? If you didn't buy a house at 139.9, like we start selling them in Ocala, you can still buy them for $299, a 4-bedroom, 3-bathroom. But if you don't buy it until tomorrow, the prices are gonna keep going up, because cost of construction is going up, cost of land is going up, everything is going up. If you go to the supermarket, your food is going up. We're not gonna even talk about gas. So understand this. If you are dreaming about prices that were 2, 3, 4 years ago, forget it. This is not the right business for you. But real estate is a team sport, is a long-term investment. And if you do it, I can almost guarantee you're going to succeed if you have the right location, the right property management, the right mortgage people on your side, the right insurance, and the right team to support you. So thank you very much. I'm Wagner, Nolasco. Today I had the pleasure to have Grant Parham, Aaron Stelly, Bill Scholz, and Camilo Saab. Go out there, guys. Love you guys. Go make something happen. Today is the day for you. Thank you very much. Have an amazing week, everybody. Take care.
Thank you, guys.
Take care,
Thank you
guys.
all.
Pleasure.
Thanks
Pleasure.
again,
Thank you very
everyone.
much. Thank you.